All right, let's get right into it. Today, we're pulling back the curtain on one of the most powerful and most secretive trading firms on the entire planet, Jane Street. We are going to break down a massive regulatory investigation that accuses them of using a seriously sophisticated strategy to manipulate one of India's biggest stock market indices.
So here's the big question, and it sounds like something straight out of a movie. Can one single firm actually manipulate an entire stock market index? Well, that is the exact question at the heart of this whole case. India's market regulator, SEBI, is basically alleging that Jane Street, with its unbelievable financial firepower, didn't just trade the market, they bent it to their will.
And, the stakes here are just astronomical. This number you see, according to the regulators, that's how much profit the Jane Street companies made from trading index options in India during the period they were looking at. That's over 43,000 crore rupees. It's an almost unimaginable amount of money. So the question is, how on earth did they allegedly pull it off?
Okay, here's how we're going to tackle this. First, we'll look at the shocking regulatory order that kicked this all off. Then, we're going to get into the real nitty-gritty, the two-act manipulation strategy they were accused of. After that, we'll cover another alleged tactic for gaming the market's close. And finally, we'll wrap up by talking about why this whole case is so important for market fairness.
So this whole thing blew up thanks to a formal order from the Securities and Exchange Board of India, SEBI. And look, this wasn't just some slap on the wrist. This was a major move designed to stop a global powerhouse dead in its tracks inside the Indian market. Now, if you haven't heard of Jane Street, let me tell you, they are a giant in the world of finance. We're not talking about some small-time shop here. This is a global trading firm, thousands of employees, operating in 45 countries. They are basically legends on Wall Street, famous for their genius-level quant strategies, and for being incredibly secretive.
So when that SEBI order came down, it wasn't just for one company. Nope. It targeted this whole web of related firms, all under the Jane Street name. The regulator barred these four entities from buying or selling any securities in India until they say otherwise. That effectively just froze their entire operation under investigation.
Okay, so what did Jane Street allegedly do that was so bad? Well, the SEBI order lays out what it calls an intraday index manipulation strategy. Think of it like a playbook. Let's really dive deep into it, using their trading on just one day, January 17, 2024, as our case study. The way regulators describe it, it's like a simple two-act play. Act 1 is the setup. In the morning, Jane Street allegedly used its massive piles of cash to artificially prop up a key market index, the Bank Nifty. Then comes Act 2, the payoff. In the afternoon, they supposedly flipped the script, crashed the index, and made a fortune on the way down. Let's look a little closer at Act 1. On the morning of January 17th, the broader market was actually heading down. But what did Jane Street do? According to the report, they swam completely against the current. They became the single biggest net buyer of the stocks in that index, pumping in a huge amount of money. This massive buying spree allegedly propped up the whole index, giving everyone else the false impression that the market was strong. Now, this is where it gets really interesting. Take a look at this data. This table shows the price impact from all the trading activity. See that middle column? That's Jane Street's trading. It had a huge, positive price impact. They were aggressively pushing prices up. But now look at the column on the right. That's the rest of the market. They were doing the exact opposite. They were selling. It was literally Jane Street versus everybody else. And here, my friends, is where the alleged trap was set. While they were very publicly pushing the index up with one hand, they were secretly, with the other hand, placing a gigantic bet that the index was about to fall. They allegedly built up a bearish position in Bank Nifty options worth over 32,000 crore rupees. Just think about that. They were betting against the very thing they were propping up.
And now for Act 2, the payoff. As soon as that massive bearish bet was in place, Jane Street allegedly pulled the rug out. They did a complete 180 and started dumping all those stocks they had just bought. This sudden flood of selling, as you can imagine, put intense downward pressure on the index.
And this table here illustrates that reversal perfectly. This is the afternoon's trading. Now look at that middle column.
Jane Street's price impact is hugely negative. They are selling like crazy, driving prices down. And the rest of the market? Well, you can see on the right they're actually trying to buy, but their efforts are just completely swamped by Jane Street's massive selling pressure.
So, what was the final score for this two-act play? This chart tells the whole story in one picture. On their actual stock trading, the buying and then the dumping, Jane Street took a loss, about 61 crore rupees. But that was just the cost of doing business, the cost of setting the trap. The real money, the payoff, came from that options position. They netted a profit of nearly 735 crore rupees on one day. The regulators are saying, come on, this is no coincidence. This was a plan.
But wait, there's more. The investigation didn't just stop at that one day. SEBI also flagged a second alleged strategy, something they call extended marking the close. And this is important because it suggests that first incident wasn't just a one-off thing, but part of a bigger pattern.
So what even is marking the close? Well, it's actually a classic trick in the book. To put it simply, it's when a trader with a huge derivatives position, like options that are about to expire, starts aggressively buying or selling the underlying stock right at the end of the day. And why would they do that? To nudge the final closing price in whatever direction makes their big derivative bet pay off even more.
And it looks like the regulators were definitely onto them. Just a few weeks after that wild trading day in January, on February 6th, the National Stock Exchange itself sent this letter to Jane Street. It directly tells them to exercise caution and to refrain from this exact trading pattern. This is basically the exchange saying, hey, we see what you're doing. Stop it.
But here's the real kicker. According to SEBI's report, that warning was basically ignored. This timeline is just damning. On February 6th, they get a formal warning letter. But then, just a few months later in May, SEBI says they observed Jane Street doing a very similar marking the close strategy all over again, but this time on a different index, the Nifty.
So, after all that, why does any of this complicated financial stuff actually matter to the rest of us? Well, it matters because it hits at the very core of what we believe markets should be, a fair and level playing field. This is not just about one company's profit. It's about the trust and integrity of the entire financial system. So let's just quickly recap SEBI's main arguments. They're saying this was manipulative because, 1, Jane Street used its incredible size to literally move an entire index, something no normal trader could ever do. 2, they created a false and misleading appearance of what the market was doing. 3, this tricked other traders into making bad decisions at artificial prices. And maybe most importantly, 4, those stock trades where they lost money, they had no real economic logic on their own. The only reason to do them, SEBI argues, was to rig the game to guarantee a huge win on their options bet.
Ultimately, this whole case leaves us with a really tough question for our modern age of trading. In a market dominated by complex algorithms and financial giants, when one firm has enough cash and code to literally go head-to-head with the entire market and win, what does fair even mean anymore? Where do you draw the line between a brilliant secret strategy and just plain old manipulation? That's the question that regulators and frankly all of us have to grapple with now. Thanks for joining me on this one.